All right, so we're just going to pick up here and talk about the perpetual inventory system. We'll probably cover the periodic inventory system as well, at least give you an overview. We'll kind of see how long it takes. We think about the perpetual inventory system. The key here is that with every single transaction that involves inventory, you're going to be touching that inventory account. So we continuously adjust the inventory account. So you're going to see a lot of entries to inventory when you have the perpetual inventory system. So whenever you purchase inventory, if you sell inventory, if there's a return, in other words, you acquire it and then you return it, all of those things are going to touch that inventory account. Cost of goods sold is also going to be a regular journal entry item. Anytime you sell inventory, you're going to record cost of goods sold at the point of sale. So again, it's a continuous process as far as recording these different journal entries. Whether you knew it or not, so in this class, it would have been like very early on. Basically, most students at this point in time have already learned to include cost of goods sold and changes in inventory as part of their normal, journal entry process. And so most students have seen this already. It's not new. And so it's, relatively speaking, the fairly easy to understand. So let's walk through an example. So 49er Company, they use the perpetual inventory system. They had all of these different events. So there's 4 different events, and we're going to record those journal entries for the month of January. So starting for the first one, on the 5th, they purchased $100,000 of clothing from its primary supplier on account. So this is a merchandiser. And so how would we record that? So hopefully a couple things, obviously, is they purchased some inventory and it was done on account, meaning they didn't pay cash. And so hopefully this kind of journal entry is pretty straightforward, but you're going to debit that inventory account and you're going to credit accounts payable to record the fact that you purchased this inventory on account. Again, noting that the increase goes directly to the inventory account. Next transaction, they sold inventory with the cost of $45,000 for $58,000. And again, the sale was on account. Another way to say it would have been, and they billed the customer. So anytime you're not receiving cash, it's either a sale on account or you're billing your customer. And one thing just to remind yourself is, whenever you see 2 different amounts in one of these events, usually you're going to involve at least 4 accounts. So it's usually the way it works, not always. Probably are some exceptions, but basically, if you see 2 accounts, you should expect 4 accounts, and of course, that's going to be true here. And so you have the inventory part, which is the 45,000, and then you have the sale part, which is 58,000. Really, it's kind of 2 different things going on, right? We're consuming inventory, but we're also generating revenue. So those 2 things. So there's an expense being incurred, and there's revenue being recorded simultaneously. So we're creating one asset and we're consuming another asset, and they are simultaneous but kind of distinct transactions. And so as we walk through it, hopefully it's pretty straightforward, but obviously whenever we're creating an asset through our operations, that's where we're generating revenue. And because it's on account, that asset is called accounts receivable. So you can see the AR account and sales revenue, those are married together. That's the creation of the asset or our ability to generate revenue. And at the same time, of course, we are consuming our inventory. And so we consumed $45,000 of inventory. And the way we record the consuming of that resource is cost of goods sold. So there's an expense, there's a revenue. One asset's being created, another asset is being consumed. Again, you've probably seen this journal entry, but I want to make sure that I explain it as thoroughly as I can. 49er Company paid $20,000 to its supplier for the inventory purchased on January 5th. So the key is on the 12th here, we've already received the inventory. So this isn't new inventory. We're just simply paying for inventory that we already received. And hopefully you understand whenever we make a payment, of course, it's going to be a credit to cash. And on the other side of that, of course, we are satisfying our liability, so that account payable is going away with a debit. And again, I'm not going to go into painful detail about debits and credits, because the hope is by the time you get to this lecture, you're really familiar with debits and credits already. All right, they paid 49er, so 49er got paid for the sale. Again, the key here is that the sale occurred on January 10th, so we already recorded the sale, and now we're just recording the payment. And of course, whenever you receive a payment, hopefully it's fairly straightforward. We're going to debit the cash, and we're going to credit the AR for that prior sale. All right. Now, with the perpetual inventory system, at certain times throughout the year, at least once a year, maybe more often, but at least by the end of the year, you're going to do a physical count. And that physical count just suggests that, we have these transactions, but other things can happen to inventory where we didn't really have a transaction. So there could be theft, error, breakage, spoilage. And so you're going to record those things. And really, the only way that you can figure out how much was stolen, broken, or whatever is by doing a physical count. Now, again, the reason why you're tracking this continuously is because you don't want to constantly have to do physical counts. And so with the perpetual inventory system, more than likely, you're going to do a physical count just at the end of the year. You might do it every quarter. You're almost certainly not going to do it every month. And so it's you don't do physical counts as often, but they are still part of the process. As technology advances, obviously we're better able to track information and track specific items. And so a lot more companies are using the perpetual inventory system so that they can track things a little more closely. Now, one that you're probably not familiar with is the periodic inventory system. So it's not, I wouldn't call it the major focus of this chapter, but we do need to understand it because some companies do use it, especially if they have like larger inventory items and things like that. So with this approach, companies, there's no continuous record of their inventory. Instead, they perform a count kind of at the end of a period, usually every month, but for sure every quarter. And of course, they may wait annually, but it would be very uncommon to use a periodic system where you only do a physical count at the end of the year. That's just not a typical way that it would be handled. But the key is that the physical count of the inventory is what drives cost of goods sold. So you kind of infer cost of goods sold from the following equation. So within the period, you have a beginning balance, then you have whatever your net purchases are because you're going to track purchases in a separate account. And then you're going to do a physical count for your ending inventory. And from there, you can infer your cost of goods sold. Beginning inventory plus net purchases minus our ending inventory gives us our cost of goods sold. So the physical count drives cost of goods sold rather than tracking cost of goods sold with every single transaction. So it's just a little bit of a different approach. Again, we're going to use this purchase account. It is a temporary account. And it is considered an expense account. So it's going to be in the 500s using our typical, accounting system, 100s for assets, 200s for liabilities, 300s for permanent equity, 400s for revenue, 500s for expenses, and 600s for dividends. Some companies use thousands, but usually follow something similar to that. But this purchase account, it is a temporary account, meaning that it's going to get closed. And really what you do is whenever you do that physical count that you do periodically, you're going to close purchases when you calculate or infer your cost of goods sold. So every month, every quarter, maybe every year, but for sure every month or every quarter is a pretty typical way that we do it. So anyway, so just kind of get used to that account. All right, so four new transactions. So there was a $25,000 in inventory on hand at the beginning of the period or the beginning of January. We have these three transactions, and then we do another physical count at the end. And from there, we're going to kind of do all of our journal entries using the periodic inventory system. Now, I'll also say usually most students do not enjoy this part of the periodic inventory system. It kind of gets a little bit tedious, not tedious, but I'd say confusing as far as the way we do the accounting. But what you're going to find later in the semester, or sorry, later in the chapter, is that when you're doing some other calculations, the periodic system is way easier. And so there's definitely a trade-off there. All right, so the company purchased $50,000 of inventory from its supplier. And again, just as a reminder, under the periodic system, we do not touch the inventory account. Instead, we accumulate purchases in the purchase account, and notice that it's an expense type of account. So we assign it for our system, we assign it to the 500s. And so that's going to increase As the purchases increase, it's an expense, so it increases with debits. And of course, we paid cash for the inventory. That's going to be the credit. So the next transaction, inventory was defective, and so they got a full refund. So essentially saying, I don't want this inventory, they send it back. But again, to be clear, we're not touching the inventory account. Instead, we're going to change the purchase account. So we're gonna take that purchase account, we're going to reduce it, and we're going to debit cash for the refund that we received. One thing, even maybe not this recorded lecture, maybe the next one. Sometimes you'll see instead of purchases, you'll see purchase returns as a separate account. It'd be like 506 or something like that. Either one's acceptable. For this section, we're just kind of illustrating the idea that we're tracking everything within the purchase account. But you could just as readily have purchases in one account and purchase returns in a separate, also temporary expense type of account. And so just be aware we're doing it this way, but later on we're actually going to show it a little bit different. They sold some inventory for $75,000 cash. And again, just to be very, very clear, we do not record changes to inventory as the inventory is sold. Instead, it's an adjusting entry based on physical count. And so whenever we have sales under the periodic system, the only thing we record is the sales portion. We do not record anything with the inventory itself. And so everything kind of stays, you record that sale, and then eventually we will figure out cost of goods sold, but it's an adjusting entry rather than something that we track with each sale. So then the final thing here is, okay, now we actually have the physical count. We're going to do the adjusting entry at the end. And so what we see here is when they did the physical count, there was $28,000 of inventory on hand. Now, in this one, we have 1, 2, 3, 4 accounts that we're going to include. And then this is going to end up being the description. And then we have sort of 2 hints. And so one is, if we accumulate all those purchases, our net purchase amount at the end of January is $47,000. Now, if you recall, when we talked about the way we do cost of goods sold under the periodic system is we infer it. And so when we infer it, it's going to be based on the change in the physical count and closing the purchase account balance. And so as you're thinking about this journal entry, there's really 3 things you've got to keep in mind when we think about, okay, how do we get to cost of goods sold? One is we do need to close out the purchase account. And so we talk about this purchase account. Is it a debit or is it a credit balance? It's for the first question you need to kind of answer. And if we kind of think back to our journal entries, I didn't do this in class, but I'll kind of show it here, is the first purchase was a $50,000 debit. And then we had a $3,000 credit, which means in total, that balance is going to be a debit balance, which is very much a typical thing. So it's supposed to have a debit balance, and it does. And so that debit balance, in order to get rid of it, to close it, we need to credit that account. So we're going to credit purchases as part of this journal entry. Now, the way we handled the physical count of the inventory, I like separating it to keep it very, very clear as far as what's going on. And the way that we kind of separate it is we take the beginning inventory account balance, which was $25,000, and we need to take that off of our books. And then we need to bring onto our books the ending physical count, which was 28,000. And so the way we take an asset off the books is through a credit, and the way we bring an asset on the books is through a debit. And so that means we would credit the beginning inventory balance and we would debit the ending inventory balance. And then from there, we can infer or plug the cost of goods sold. So again, we're removing purchases through a credit of 47,000. We're removing the beginning inventory balance through a credit, and we're adding the ending inventory balance of 28,000. And then basically this 44,000 is just whatever makes this work. So it's 72,000 minus 28 gives us 44,000 using that same equation. So it's a plug is what it is. And so again, this is the periodic system. Most people come to this journal entry and they're kind of like, what are we doing here? But the nice thing is I didn't have to worry about the inventory account until the very end. And so it does become simple in that regard. And so what is the trade-off between these two systems? So the periodic system, less expensive, less time consuming. Obviously, most accounting systems, once you have the physical count, it's a fairly automated, fairly straightforward calculation. Um, Obviously, the perpetual system is going to give you a better information, more timely information compared to the periodic system. And so, again, there's this trade-off of timeliness and quality of information versus cost and the time that it takes to actually prepare the information. All right, with that said, we're going to stop this one and then we will jump on to the next topic here in a little bit. Oh, let's see if I can.